10 to 12 hours or 5 days or a week. There's lots of stuff to cover. We're going to gloss over things at a high level. It's probably going to be geared more towards the selling your business aspect of things, but we will touch on everything. We're also going to talk about the decision to sell. We're going to talk about due diligence. Yeah, I know. I got it, Maria. The transaction phase, and then post-closing issues. And those like 4 subjects, we're going to melt into the whole presentation. So it won't just be we're doing one and then the next. They're all kind of interrelated, especially some of the front end stuff gets into the back end stuff. So bear with us there. And I'm Corey Van Duzen, tax partner at Lums and McCormick. We have this panelist here, Christian Lovelace, a partner at Lippis Matthias. And he has beautiful hockey hair in the picture there. Look at how short that hair is. I'm sorry, Christian, I couldn't help myself. We have Adam Harris here from Paramax, who I learned today is also a CPA. We have Bill Allen, one of my partners at Brisbane Consulting. And then Cheryl Jankowski, another one of my partners in the tax department and specializing in succession planning. So one of the first things that we were, oh, wait, no, Maria, I have to do polling question number 1. Come on up. So this is, sorry for the painful polling questions, but to get CPE for the CPAs in the room and online, we have to ask these questions. Let's see how fast you can press that button.
You guys can chime in too.
No one's here to learn. They're here to network. All right, thanks, Maria. How do I get? Sorry. So the first thing that we're going to talk about is the decision to sell. And Cheryl and Adam, I think you were going to go through some of the thought process if a business owner is looking to possibly sell. I'll let you start here.
Great. We'll see who gets to drop the cell phone first. I'm probably counting on myself. So welcome, everybody. So one of the things that I like to talk to our business owners about is what are their plans? Businesses are going to transition whether you want it to or not. Not everybody lives forever. So sometimes it's intra-family transition or a management team. Sometimes businesses just unfortunately fail or they decide to close. But what we're really focused on today is that third-party transactional, we're selling to an unrelated third party. So that's really what our focus is today. So once we know that a business owner is looking to sell, we really want to understand how long is it before they're thinking to really sell. Most of us in this room probably know people that got unsolicited offers and that decision to sell was accelerated. But if you plan proactively when looking to sell your business, there's amazing things that you can accomplish. So those are the things I'm going to touch on very high level. So with advanced planning, we can help, in my world, minimize your estate taxes and income taxes. That can be huge for generational wealth transfer. Another key area, we're sitting in New York State. What do you think is one of the first questions most people say? Is there a way to avoid New York State income taxation? So with proactive planning, 3 to 5 years out, we really can get you in a better situation. Maybe we can't eliminate New York State income tax, but we certainly can try. We also want to understand your cash flow needs, that business owner's cash flow needs. And it's very important. We want to make sure, and Adam's going to touch on it about the business value, because that's really going to drive the business owner and what they need to sell. So often when I talk to our business owners and say, well, how much do you need a year if you sell this business to live the lifestyle you want? And the number varies. I think I need 500,000. I think I need $1 million. And then I ask the question, before tax or after tax? Oh, and so they're not doing the homework necessary to really understand how much cash flow they need to maintain their lifestyle for the rest of their lives. So really, I've only worked with one client who actually had a budget for himself and knew how much he needed to bring in because he knew what his expenses were. And That is not most clients. That was one client in my 30-year history. So really make sure that you're doing your due diligence there. Understand the benefits you're getting from your company, wages, medical insurance, some of the things that we think about all the time is compensation. What about the club dues? What happens to medical insurance? It can get pretty expensive if you're buying that on your own afterwards. So think of those other benefits you're getting from the company before you're looking to sell. And one of the last things I really wanted to touch on before I turn it over to Adam is, is what's next. So you sell your business, a lot of who you are is tied to that business. I'm a business owner. Oh, I sold my business. I'm a former business owner. So there's a lot of pride in owning your own business. And so you really need to understand what that next step is. A lot of business owners are very motivated individuals. They are just go, go, go. I was talking to a client recently who had sold her business right before COVID. And she's like, nobody told me there was nothing to do in retirement. Now, we could talk to another business owner and that would not be their answer. So you need to understand who you are and what fulfills your life. The other thing you need to really look at as a business owner is your connection to your employees. All those individuals you sell your business, they all just got a new job with a new employer. And sometimes that can hold somebody back to moving forward with selling their business. So with that, knowing that we have a little bit of shortened time, I think we're going to turn it over to Adam to really talk about, I talked about how much cash flow you need. Adam's going to talk about how we can make that number for your pool a lot better.
Thank you, Cheryl. Yeah, I think, like you said, Corey, there's a lot to unpack here. Selling your business is a big thing. It's a big deal. Right there. It is a big deal, and I think a lot of people walk into the process really not knowing how long it takes, being one of them, and what's involved. What's the commitment for me personally and for my people? So starting there, I think I'll unpack it a little bit in terms of things that we see on a daily basis as we're going through deals, pitfalls, some of the things that clients probably wish they knew in advance when, we're brought in, late in the game. One of those is the impact. Obviously, I'll start really at its basic kind of form is, what does the EBITDA look like? What does your history of cash flows look like? I think you can talk to anybody that does valuations, as a job, or buyers that buy businesses. That's always where they start in terms of building their valuation for a business. The biggest and the most critical piece of that is the sustainability of that EBITDA, right? So I think we saw a lot of people, especially during COVID, either they were impacted in a very negative way in terms of they couldn't get supply or whatever the reason might be. We also saw some companies do very, very well, really as a result of temporary price inflation or whatever it might have been. So it's important to early on analyze those and those factors and think, okay, how does that impact the valuation of my business? Buyers will look for sustainability. I mean, we're going to talk about diligence later on in this presentation. That's a big piece of what they're looking for, is to figure out, okay, what's the quality of the earnings and what can I expect going into the future for this business? And I think that's something when, advisors are brought in early, they can have that, do their own diligence, have the conversations with the clients to figure out, okay, you had one very good year, but let's strip that down a little bit and figure out why you had that good year. What does the history look like? And what does the forecast look like? Because every buyer is they're not buying the business for this year. They're buying the business for the next, if it's private equity groups, maybe it's 5 years. If it's strategic groups, maybe it's a long, long time. So I think it's important to identify that, identify the reasons that's driving the results of your business. And, I think that can go a long way to start thinking about that very early in the process. Yeah.
You've used the term early a few times.
Yeah.
Is early like 3 months before you decide to sell, or how early should I be talking to my advisors, my attorney like Christian or Cheryl about estate planning?
So what I can speak to is kind of how long our traditional process takes. This is right. There's a lot of different forms that a transaction can take. It can be an unsolicited offer that somebody gives you, right? A group comes along and drops an LOI on your desk and they say you have a week to decide if you want to sell your business. The advice I give those people is to say you don't have a week to decide. Take a step back. If they really want your business that badly, they can wait. What they're really trying to do is get you into a position where you'll sell your business without thinking what the alternatives are. So the advice I give people in that situation is reach out to somebody. Maybe you have a friend that sold their business. They can tell you kind of the experience they went through, or reach out to one of us or an advisor, somebody that does this on a daily basis to say, you have other options. Here's what the market looks like. Here's what the multiples are looking like in your industry today. This is where they were a year ago. This is where we anticipate they could be in the future. In terms of a full process, we usually say 9 to 12 months. It's usually from inception and us starting to do preliminary diligence to closing on a transaction. So if you can get to your advisors at least a year in advance of when you're trying to think about when you might be selling your business, I think that's a great starting point. But my, I guess parting words on this topic are, it's never too late. We've done deals, Christian, we'll talk about this, right? You've done deals where you've come in at the 11th hour, post LOI, it's already signed. We're going to talk about a transfer of leverage. As soon as you sign that piece of paper, you immediately lose some leverage, right? I think there's so much that can be done before you sign an LOI in terms of getting yourself positioned for when, the definitive agreements are structured and signed later on in the process. So.
Can I just chime in? And I know I have to talk very loud. So if you're looking for some real wealth transfer, and especially if you have an estate tax issue, we want to get in there earlier. So 3 to 5 years, because we don't want to be doing some transactional stuff and then you have a sale like that. So, there's different time horizons with that. And just looking, what are your value drivers of your business to really maximize that multiple is important as well.
Yeah, what I was going to add to that is, how early for your advisors? Well, we each play different roles, whether it's prepping your business for sale, right? Kind of going through preliminary diligence on what you have, estate planning, tax structure is another one, legal structure is another one. I've been in 3 deals in the last year and a half where we get to LOI stage. I'm not brought in, tax advisors aren't brought in on either side. It's just 2 business owners, maybe it's an add-on, strategic add-on, and you get to LOI stage and you realize that, well, we want to acquire this with private equity. Well, what's seller? Well, seller's got some LLCs, we're going to buy them. Okay, sign the LOI, finally get diligence, and hey, guess what? All these LLCs are elected S corps. Well, now what do we do? Well, it's a very different transaction for everybody involved, the investors, the buyer, the seller. And you got to adjust. If that was done on the front end, you can do these tax reorganizations to get the benefit for both parties, gross up the purchase price, whatever you may need to do, F reorgs, 338s, whatever the tax structure, these guys come up with to provide value on the sales side. You'd rather not be negotiating the purchase price at that point in time, or renegotiating leverage on the LOI at that time, or maybe it's the purchase agreement stage. So early on it can be different stages, but certainly when you're considering to sell, there's so many things you can do. Clean up your diligence, clean up your contracts way ahead of time, identify liabilities for Adam and his group so they can try to remedy them in the pitch, in the offering materials that they're giving out, hopefully to make the bids more competitive.
So next question is, what are some of the expectations you try and set with your clients when they're deciding to sell their business? You want to take this one, Adam?
I can kick it off. Yeah. I think, and Christian, you bring up a great point in terms of, identifying the risks, right? Identify the values. I think we have a lot of people come in that say, okay, just get me as much money as you possibly can for my business. Yeah, obviously that's the goal. We're going to try to do that every time for you, but there's a lot more. And I think, Cheryl, you identified it, right? What's going to happen to me post-closing? What's going to happen to my people post-closing? Maybe I have family members in the business. What's going to happen to them? There are so many structural things too that we will just touch on in terms of the definitive agreements later on that really dictate liability, post-closing, those type of things. It is always going to be a give and take between buyer and seller, right? We've seen deals fall apart because either a seller is not willing to give on anything or a buyer's not willing to give on anything. A deal's never going to happen if that's the case. A deal's only going to happen when there's give and take. Knowing where you want to give and where you want to take is probably the most crucial fundamental understanding for a client to have walking into a sale. Let's have that conversation day one. Let's not have that conversation the 11th hour when purchase agreement is getting drafted. We need to know what you care about so we can fight for you. That's
where
really...
that can really matter is we'll get term sheets or LOIs that are very vague. I got a deal, I got the price, I'm happy. And maybe it's via competitive process. Well, when you don't weed out a material negotiation point and you say this deal isn't for me anymore, because now we've gotten to a 60-page purchase agreement with all the belts and suspenders that you have to make up your mind as a seller on, including that post-close risk. Wait a minute, I thought I could sell my company and I'm in Florida. I'm good, right? No, you have a cap of $3.5 million of liability that's following you if you didn't disclose things right. Well, I didn't sign up for that, right? So if you try to cross that off, because if you don't, you're putting your business back on the market like you would if you were to put your house on the market for a year and it didn't sell. And then you would it's got red flags. Same goes for the similar sentiment can go if other prospective buyers in the market here, ABC companies for sale. Oh, I hear it's under LOI, deal died. Well, why is it back on the market? What's there, right? And they're going to dig harder into your diligence because something must have come up. So you'd rather do it right the first time, notwithstanding the fact that you're paying professional fees on the first time regardless, right? So unpacking the risk, unpacking the diligence, making sure it's as clean as it can be going into that diligence and purchase agreement stage is
So we've spilled into pre-due diligence and due diligence. So we need another poll question here. Sorry. We had a poll up because we spilled into due diligence. So please answer the polling question. Thank you, everyone.
Can I comment on this polling question? Because I think it's
Yeah.
You don't mind. A lot of people said no, right? In terms of inflation is not dictating whether or not I want to sell my business. I think what we tell everyone that we ever talk to is you can sell or buy a business in any market, right? I think there's always something happening in any given industry every single day. There could be political things happening where you're like, right? Was it 2 years ago? Potential massive tax law changes, right? We saw a bunch of clients come in, we need to sell our business in 4 weeks. And it was like, well, slow down, let's break this down and figure out what you care about and what's concerning you. I think it never happened. We have not seen deal flow slow down at all, even though there's all these things happening with interest rates and what have you, in the economy right now.
Only buyers with so much money outside of the big lenders.
Exactly.
source of wealth. It
Right.
just shifts.
Yeah.
Now with due diligence, can we go over some of the best practices with due diligence?
Yeah, who wants this to start?
Billy, you want to take?
Sure.
Take it all.
Yeah. So from I'm just the eye candy. Sorry. From a financial due diligence perspective, organization I think is the key. Sometimes what I found is, especially when you're selling businesses that have, EBITDA that ranges from $1 million to even $10 million, there's one or two individuals that are ultimately responsible for fulfilling all the requests. They get inundated. It's overwhelming. And anything you can do in that pre-stage prior to the LOI, just to get organized, the basic requests, right? Financial statements, tax returns, accounts receivable aging schedules, bank statements, all those typical financial documents they use to run your business. Guess what? The people like me are coming in to look at, so we can tear that nice, pretty glossy report that Adam put together apart and say, I'm not paying you that much money. So really anything that you can do organizationally just to be ready for it usually makes the financial due diligence process, seamless, or as seamless as you can. One of the best examples that I can think of that I've seen is, all of the individuals that were part of the accounting process were interviewed and screened, via Zoom, and they were provided to the due diligence team. So in terms of operationally, how does the billing process work? How does the accounts payable process work? All of these things are on video, and it really made the diligence process for a relatively sizable transaction much easier and smoother, because we didn't have to schedule all of this while we were doing it. It was at our fingertips, and we could just ask follow-up questions.
Can I take a comment?
Please.
So I was involved in a sale of a business one time, and Billy was commenting and made me remember this. And the family business didn't really have a CFO or a controller. They had a bookkeeper because one of the family members had gone to accounting school for like a year. And I thought it was a great sale the first time they got an offer, and we went through the whole process, and then it just bogged down and stopped. They got another offer, went through basically the same exact offer, but you know why it went through? Because we already built all the financial reporting and dotted our I's and crossed our T's under the first LOI and had all that stuff ready to go. So we were prepared the second time, we weren't prepared the first time. So point is, if you're trying to or thinking about selling a business, and you have your mother-in-law or something like that doing the accounting, and she can do the cash recs, but not really do the financial analysis, go talk to your CPA, go talk to your financial advisor, and get ready now if you want to sell in the next 3 to 5 years.
So when we talk about diligence, and there's many in the crowd and online that understand what diligence is and the process around it. You know, a good way to think about it for those that maybe don't is there's a financial diligence aspect to it, which revolves around EBITDA, working capital, value, right? And there's the legal diligence aspect around it that I'm quarterbacking, along with financial diligence, because there will be those reps in the agreement. So from a financial diligence, you know, having that stuff in order, I know it's easy to say and maybe common sense. Yeah, of course, I'm going to have my financial statements and my tax returns and my, you know, all that stuff organized. But when it comes time, the diligence requests from these accounting firms are no joke. They're like, they blow mine out of the water. I mean, they're massive Excel spreadsheets that make your mind hurt. And you give that to your in-house CFO. I don't care how long they've been doing it. And a typical response is, wait a minute, are they questioning how I do this? Are they questioning how I report this? Is this under GAAP? Is this tax-based? All this stuff happens. I've seen internally the seller's CFO, controller just clam up because they think they're being attacked. So having that conversation on the front end with your outside tax advisors, say, this is what's coming, right? This is what's coming. Don't worry about it, but this is what we need to be prepared for. I've seen deals just delay for months just on that aspect because I can't move forward. So on the legal side, I do a similar sort of I guess process where I'm in there to understand what you got under the hood that can be portrayed and disclosed in the right way so that we don't cause more problems. It's like you're not going to hide if you had a stroke from your doctor. Don't hide that you have litigation. Don't hide that maybe you have underfunded benefit plans. Don't hide all these different things. Tell me about it because we got to disclose it at some point. And maybe I can get thresholds in the agreement to, you know, certain spots where I know we're not going to have to disclose something. So taking that time, running it through me, right? The other common problem is I represent a client. He's 70 years old. He's a handshake guy. This happens all the time. And he's got a buyer. The buyer's 35 years old, real great guy, old soul. I shake hands, had coffee with Bob. And my client's just unloading the truck right in front of, you know, at Spot Coffee. Like, here's everything I got. Here's what I do. And don't worry about them. I don't have a contract signed with them, even though they're a material client, but they love us, right? So trying to unload and unpackage that has to be run through the right, you know, team. And I guess the diligence process, I mean, it's what creators deals. I mean, it's usually that creators deals, not the purchase agreement.
So you mentioned the list from the accountants. That list is very long. And Billy, what does that list produce? What do you use that list for?
So primarily, especially when there's senior debt involved, or even, you know, when there's some sort of investment, whether it's like a search fund or a private equity fund behind it, and they're more passive investors, they require an independent due diligence report. And typically that due diligence report, it's synonymous. It's called a quality of earnings report. So basically what we're looking at is we're assessing the quality of the earnings. So a lot of times in the prospectus, if there's a sales prospectus, there's, an adjusted EBITDA number that has, the broker or the investment banker has come up with, and we're trying to verify that and identify the risks with that EBITDA. So we're typically looking at a 12 to 24 month period plus the last 12 months. So for instance, what kind of sales concentration do you have? And, is it seasonal at all? We're looking at the underlying expenses. Depending on the size of the business, there's all sorts of discretionary things that need to be added back or not added back. We're looking at vendor concentration. That's the quality of earnings component. Within that, though, there are a couple other key procedures that we almost always do. One would be we're determining, cash-free, debt-free working capital on a monthly basis for a period of anywhere between, 12 to 24 months, so they can develop that working capital peg, which we'll get into the transaction phase. The other thing is we're doing a proof of cash. We're looking at, can we take the reported revenues and the disbursements and from a forensic standpoint, reconcile it back to the underlying bank activity? Because if you can't, well, then we have a lot of questions. I look at that process depending on the buyer that we're working with. Sometimes we work hand in hand. They want us to get more involved operationally. They want to know more about revenue recognition. Sometimes that quality of earnings report can be basic. It's really driven by who is the ultimate end user, and that really dictates what other procedures get performed within the context of the report. Yeah, a lot of times it is the bank, and it's a negotiation. Sometimes they give you a laundry list of items where they say, we need to know all the accounting policies and procedures that you would typically see disclosed in a financial statement. Well, if you're dealing with a company that doesn't have any bank debt to begin with, none of that is documented. So you're going through and documenting the footnotes that you would find in a financial statement. So that can take some time. You might say, I just want the last 12 months and the prior year, and the bank might say, no, we want the last 2 prior calendar years and the trailing 12 months. So they dictate what we ultimately do, whoever the end user is, and it's a dance, so to speak.
Do you want to
Can we
define?
move into the transaction, or did you have a comment?
Well, I want to pause while we
Sure.
maybe define what cash-free, debt-free.
Yeah.
is, just so
Not-
in case the room.
No, that's a great point. So 90% of all transactions are on a cash-free, debt-free basis. So when the business transfers to the owner, all of the cash has effectively already been distributed to the seller, and there is no debt. They're responsible for paying off their debt. So when we're calculating working capital, we're looking at the other components of working capital. So what other current assets are there on a balance sheet besides cash? Well, there's accounts receivable. There's probably some prepaids. Inventory may or may not be a bolt-on asset to the deal. Likewise, for liabilities, there's probably just accounts payable. Maybe there's some accruals, and you got to be careful with that. Paid time off, whatever it may be. So cash-free, debt-free working capital, we want to look at on a monthly basis for a relatively lengthy period of time, because we need to define the normalized level of that working capital. I think, and we might touch on this in the transaction phase, but let's just knock it off our list real quick. What people don't realize is that when you come up with this multiple, I'm going to sell my business for 7 times EBITDA. Sounds great. What's in the multiple? And that's valuation theory. What's in that multiple is really the fixed assets, the goodwill, all the intangibles, and a normalized level of working capital. And that's how we come up with the peg. And that's important to determine.
I think we're moving on, right? So.
Yeah, we need to do the polling question.
So we did a polling question there, and it's, what part of the buy sell process most concerns you as a business owner? And with 56% cash flow after the sale purchase. Cheryl, that's your department, right? We'll talk about that in the post close, I think. All right, we can. All righty. So we talked about the torture of due diligence and all the questions that get asked and all the information that gets exchanged. How does that get us to the transaction phase and actually closing this thing? Christian, Adam?
Christian, probably.
Yeah, sounds like, yeah. So this is where everything gets offloaded to me. So the whole point of diligence is the definitive agreements in any transaction. I don't care if it's asset, stock, merger. there's going to be a series of representations that the seller is going to have to make, oftentimes in closely held businesses individually as well, right? Or guaranteeing those. And that's going to dovetail with post-close risks, meaning if you omitted something, if you fail to disclose it properly, and I'm a buyer and I got to take a liability post-close, and that could be an indirect third-party liability, and I have damage, I have recourse. So one of the most, if not the top 3 most heavily negotiated thing in an agreement is that indemnity cap. How much am I on the line for and how long am I on the line for it? Now, there's certainly market standards that we go by, certainly as deals get higher and higher, 25, 35, 50 mid-cap higher deals. There's lots of marketplace surveys, and every year we go through it as a group here on where we're at with negotiating. Oftentimes I'm on a phone with a partner and say, all right, this is a segment, this is the industry segment, this is purchase price. We're not using R&W insurance. I'm not going to get into that today. We don't have enough time. What are you seeing as far as these metrics? So you can negotiate as best as you can, but you can also use the leverage from other pieces of the deal on that as well. So the diligence, if done correctly, makes that transition to the purchase agreement much smoother, right? I can have a series of schedules disclosing everything to the buyer and feel comfortable that their post-close risk that goes along with what Cheryl will be advising. This is how much you need to live. Oh, by the way, you have $500,000 in liability post-close. All you get is a reduction in purchase price and tax exposure. That's all you get for that. So, again, I can't emphasize enough disclosure and understand. My role is I have to understand your business and I'll use the word again, unpack the liability and risk exposure you have. So I don't know if you want to add to that.
Yeah, briefly, I think just maybe with a story and just going back to, I think we brought it up before, the transfer of leverage, right? In terms of identifying a risk allocation, right? What do I truly care about? What do I not? Where can I give? Where can I take? So this is where all of that comes to fruition, is in the purchase agreement and the discussions with both parties. So we had a situation, there was a deal last year, it was a sizable transaction. There was a massive potential liability identified during the diligence process. We were blindsided by it. We didn't know about it, but it was there. The likelihood, though, of it actually something happening with it, we're talking about $15 million of potential liability was kind of the maximum exposure. The buyers were very concerned about it, obviously, right? Buying a business with this potential exposure. They carved out a specific indemnity reserve for that, and we took that and said, okay, client, what is your actual level of concern with this? Well, it's very low. Well, what can we do? We'll give on this, right? No issues at all. We understand. What can we do? Well, we played around with working capital. We played around with, we were able to turn them more towards a forecasted EBITDA number and actually put a multiple on a forecasted future number, which you can probably, doesn't happen very often. But that's one of those situations where, and then with working capital, right, we put a collar around working capital where essentially, normally it's okay if there's up or down outside of the working capital peg, which I know you talked about the target. It's a, somebody owes somebody something post-closing when you do the true up. So a collar is a range. So normally the way working capital works is there's a specific target, let's call it $5 million. If you're up or down a certain amount, sometimes it's dollar for dollar, there's an exchange that has to happen. What we were able to do was negotiate a collar, which essentially was 5% on either side of working capital, which meant we had $1 million of cash flow flexibility on either side of that peg to work with. Well, all of a sudden there's an opportunity, right? We have 3 months till closing table. You're running your business. You can probably look at that and say, okay, well, how can I adjust in terms of my cash flow management to potentially benefit from this? They ultimately ended up saving about $1 million. So plus getting about $15 million from using a future number. So about a win of 16 million with the likelihood of losing 15 million down the road, about 2%. So that's just a situation where we knew what they cared about. Even though we were blindsided by this risk, we were able to kind of turn it into an opportunity for them to take advantage of. So
what if during the transaction phase, the buyer and the seller are kind of disagreeing about EBITDA or the multiple, and projections on the seller side are maybe a little bit rosy in the buyer's mind? Is there some sort of compromise that we can have? Billy, you haven't talked much. Come on.
I think one thing that we've talked about before and we see is earnouts are a great way to compromise. You know, let's make a portion of the purchase price predicated on the financial well-being or results of the company once the seller takes over, or I'm sorry, once the buyer takes over. That's a good way to compromise. And sometimes I think Christian can attest to probably more than I can, because he's the one really trying to get the ball across the goal line at the end. It may be the one way to do so is via earnouts, as long as they're reasonable, right?
Yeah, in earnouts, you'll see from time to time, they're tricky though. It's easy to say, all right, well, we'll just come up with a scenario where the company does well and seller, everything that you say is true. Of course, I'm going to pay you, and maybe I'll pay you a premium if it does what you say it's going to do, which typically, you know, is a consideration for a seller to agree to the earnout. He's getting less money at close. Well, if we're going to do the earnout, you're not going to pay me 10 million that we agreed to. You're going to pay me 11 million if it hits these marks, right? That being said, who's controlling the earnout? And the answer is the buyer. The seller's not controlling the company anymore. So really understanding that, okay, you're gonna rely on this earnout. Hopefully, it's not a big chunk, right? Maybe it's just a little sliver of the purchase price. But you know, there may be some controls. You'll typically see earnouts more with succession. I shouldn't say succession, but post-close employment or consulting, right? So I'm buying your business. You've been running it. You're maybe a founder or third generation. You know the players, the people. I want you, and that's a condition to me buying your business on for a year or 2 years, right? That's a positive place for an earnout, because now you know you're going to be put in the position to help control that and monitor it. You know, whether there's audit rights or consent rights, depending on how big the earnout is for that seller. How the earnout is earned, benchmarks, financial. I mean, so getting to an earnout, that could be great, and that could bridge drafting, negotiating, and figure out the mechanics of the earnout. It's complicated, and it's one of those things where, you know, no one method is right for all or close. There's a lot of different ways to do it.
Just to clarify, really, you're saying that if you know the seller is going to stay on an independent contractor role for a while, there's some of the risk gets taken off the table, because they're probably they're still transitioning all those client relationships, and they have some skin in the game, and they have some control over making sure that the earnout's attainable, right?
Yeah. So many times, the big reason for having the founder come on is the vendors and the customers, right? And getting them to transition, not only from a contractual base, hopefully you do that prior to close, but from a relationship perspective. And if you can, in a lot of earnouts that I draft are linked heavily to revenue 12 months or 18 months post. Well, that means all those customers got to be staying in order to get there. So if I know that I can retain X percent, 90 some percent of customer basis and revenue post-close, I feel comfortable about the earnout. I'll accept the earnout. Yeah, and I'm going to take a premium for it, right? So anyways, but yeah, so the point is they can be very complicated.
Thanks. So we're moving into the final topic of the presentation, and that is kind of post-closing issues. And I thought, Cheryl, you might want to kind of comment on the comment or the polling question that was about, do I not have enough cash, and how much cash, and what should I do with it?
So when I talk about a client exiting their business, number one, that's why we want to plan ahead. We want to increase the value of the business as much as possible, so that on the back end, when we've monetized the business, you have enough cash flow. And Corey loves when I say this, so I'm going to give him a plug. We have to understand the client's burn rate. How much cash do you need to go through? And it's different for every client. And it's really important that there really is some analysis done as to, do you want $1 someday when you pass away, or do you want to leave a pool of money to the next generation. So those were one of the things that are really important, because if you don't know, somebody says they won't go and you won't sell the business. You might get cold feet at the last minute, and you don't want to spend all this time and energy transitioning the business only to get cold feet at the last second. So really make sure you're reflecting on that. And then I had just one more thing that we didn't touch on, but has been coming up in due diligence, is sales tax has reared its ugly head with this Wayfair decision from a number of years ago. That's what being proactive and working with your advisors, they're going to be able to help you identify those areas that might affect the value that you'll get at the end of the day.
So how many people in the audience, raise your hand, have family members that are in Florida or moving to Florida or talking about moving to Florida, or you guys want to go to Florida someday? Yeah, everybody, right? Okay. So if you think you're going to sell your business and it's going to be a stock sale a year after you move to Florida because you changed your residency and you're not paying attention to sales tax that Cheryl was just selling, guess what? The buyer's not going to buy the stock. They're going to buy the assets, and your planning that you did and the 60-point checklist that you did to move to Florida and change your residency to Florida, it's not going to be worth anything. So if you are planning on selling your business and you want to move to Florida and that's a play you want to make because you want to avoid as much New York State tax as you can, make sure you're paying attention to sales tax. And what does that mean? If your customers, if you're providing services or anything like that, and your customers are all over the country, or you're shipping stuff all over the country, and you're only filing New York State on your tax return and only filing New York State sales tax return, you probably have a problem. And go see your accountant. Billy, do you want to? We're gonna go a couple minutes over if that's okay, maybe 5 minutes. Billy, you want to talk about the final working capital computation and how that impacts a seller?
So we said before that sales are typically on a cash-free, debt-free basis. But there's a level of normalized working capital included in the sales price. So effectively, when the seller turns the business over to the buyer, they're turning over some working capital. Somewhere between 15 and 90 days, and the goalposts are probably closer to 30 and 60. It's kind of tied to the cash conversion cycle if done right. The buyer will do a final working capital true up, and they will put together a schedule that effectively says how much working capital was truly turned over to the within the business. As Adam said, depending on the type of transaction, there could be a collar on it, and that will dictate if anyone who owes who. For instance, the seller, there might have been a shortfall, and the seller will have to pay out of escrow or something, some of the working capital of the buyer, or vice versa. I think Christian can attest to this, and I've seen it because have been involved in litigation over it. This area is oftentimes one of the most contentious components of a sales process. People love, for whatever reason it is, they love to fight over working capital and the true up at the end. And, a lot of times agreements result in binding arbitration, or, you pick an accountant, we pick an accountant, we'll agree on a third accountant. Well, no one can agree on the accountants. And a lot of times it's a cluster. The accountant. Right. It's the best way to do it, to predetermine the tiebreaker.
It's like 20% of working capital gets fought over in litigation.
Right.
Yeah. So I would say 25% of working capital adjustments post-close are disputed, argued over, and everybody's got their accountants going in the transaction, but I don't do many agreements, probably unless they're south of 1 or 2 or 3 million, where we're not picking an independent CPA firm that is going to tie break this thing.
Yeah. I mean, and we've been appointed to tie break it before. Everyone gives you now it's electronic, or they give you their binder of all the support for working capital, and it can get esoteric at times of truly what was turned over, what wasn't. And if you close on a date that's not specifically month end, or for whatever reason the seller says no more due diligence, we're closing, that can create some conflict in terms of the final working capital.
Seasonal
businesses, especially if you haven't contemplated that and the working capital peg that's included. Yeah, you're right.
All right. We're going to go to questions in a minute, but I thought I would give everyone one last chance to leave people with, we already did the polling question, to leave people with something to think about. And when I'm involved in I'm going to go first if you guys don't mind. I like to talk if anybody doesn't know. When I go through a transaction like this and I'm advising a client, especially on the sell side, I always tell the client, don't look at the top number. I don't care whether you sell your business for $40 million, $50 million, or $35 million. What matters is the structure of the deal, when you're going to get paid. And you need to tell me, what number do you need in your bank account after the taxes are paid and after all the liabilities are paid off for the business? Because that's the number that matters. Because you might sell a business for $35 million and it be structured one way, and you net more than if you sell it for $40 million structured another way. So that's the important number that I bury into a client's head at the beginning. And based on the structure and the purchase price, we figure out whether we can get to that goal. And that's what I'll leave with you with today. Christian?
Yeah, no, and to piggyback that, I have a couple of clients sitting on the sidelines for, some a couple of years, some 5 years. They came to me and said, I want to sell my business. We ran that analysis, and wherever their stage of life was, maybe they're in their 20s or 30s, said that's not enough. We'll just keep growing it. Come back in 2 years, Bill runs another valuation. What does taxes look like? What do your sales look like? Wait, now you're selling software, whatever you're selling into this state and this state. This is what we're looking at now. Okay, not ready yet. Partner gets bought out. So you see things change over time, but it's really helpful in that stage. We have years of planning. Anytime I form entities for them, anytime we do anything structurally, I know that's in their back of their mind that they might come to me and say, I want to sell. So we can structure around doing that. So I guess, I'll take the low hanging fruit. The simple answer is, if you have any inclination of selling, just have a conversation with some advisors. And it's probably going to be fairly quick on the front end, but just to understand how you sit today, where your revenue is, where your jurisdictional presence is around the country, how you're taxed. More often than not, I see simple things like that go overlooked just because you're running a business. You got a lot on your plate. You're dealing with people, employees, and the whole tax thing. Your tax advisor may not be on the same page with your attorney, right? So the tax person is filing it. If the attorney knew he was filing that way, they would have changed it, right? And there's a lot of ways to do it. And certainly with some tax elections, you need time, right? You need to get them in prior to.
Yeah, I think really quickly, I think a lot of the points you brought up are very good ones, and ones I share your sentiment on. I think the one, just piggybacking off that, the other, regardless of where a seller's at in the process, deciding, okay, maybe I want to sell tomorrow, maybe I want to sell 5 years from now. Think about your business and run your business in a way as if you are planning to sell, right? Think about what a buyer might look at. What are the risks that they're going to identify in your business? Have a very honest conversation with yourself, right? I think everyone has a lot of pride about how they run a business and build a business, but talk to people, talk to friends, talk to advisors, understand what some of those risks are so you can mitigate them in advance. Maybe you don't have somebody next in line to take over the business when you want to leave, right? A buyer, depending on who the buyer is, they might really want to see that, right? They don't want to go out and have to hire somebody day one to come in and run the business. They would love maybe a succession plan where you've put the right person in place, you've trained them for the last 5 years, and that business is ready to plug in, and it is a pure bolt-on opportunity for them where they plug it into their business and they're rolling. So that's just one of very, a massive list of potential risks and, items to look at. But I think it was worth bringing up. So
Here, I got one comment on that. All right. Just to piggyback off that. So you're telling everybody, if they want to sell their business, to build a turnkey operation, right? So the owner should be able to take a vacation for a month. If you can do that, that's going to maximize some sale price to a buyer.
what buyers are going to buy. What buyers are going to buy as well.
Right. You stole my thunder on the turnkey there, but the biggest intangible asset for most middle market to small market companies that we're dealing with, it's not their brand reputation, right? It's their trained workforce. So the more you invest in your people, the better off you are. I mean, we're not selling Google here. We're not selling that name or Twitter or whatever. We're dealing with, middle market to small market companies where they have brand recognition, but really it's the people. That's the intangible asset.
I think the team made all great points and stole a lot of my thunder. I think the key thing is reach out to your advisors. There's so many times that as an advisor, I said, if I would have known, if you would have told me, and the horse is already out of the barn. If you have clients that have C corporations that have been C corporations for a really long time, let's chat, because maybe that's not the best structure. Too often I see business owners going to sell, and had we known that was their exit, we would have made an S election. And we're not going to bore you with all the tax implications, but at the end of the day, we can put more money in your pocket if we know that what your goals are. And with that, I'm going to turn it back over to our MC, Corey.
Those online, if you can type in your questions, we will read them aloud and discuss them as a group. And with that, there's no questions in the queue right now. So does anyone in the audience have any questions? Anybody want to know about the 338H election or anything like that? I was joking. I don't really want to do that. Bueller, anyone? We're going to hang out and have cocktails. All right. Oh, we got a question. So as a seller, in case they didn't hear, as a seller, what type of fees should you be thinking about in the selling process?
So yeah, so fees, can be kind of a percentage aspect to it. Certainly Paramax and other investment bankers have their own sort of model, right? Lumsden, Lippis, it's an hourly sort of thing, but they can range. I've done $5 million transactions that were six figures. I've done $70 million transactions that were not six figures, based on the type of business that I'm selling, the mechanics to it. Is there real estate involved? Is it software driven? Is there environmental IP? Do I have to bring in specialized IP counsel to analyze patents that we're buying? Right. There's a lot of factors that go into it, but certainly, once there's a saying we have, it's like it's a $5 million deal, but it might as well be 50 million as far as fee goes. And that a lot of times you're doing the same stuff in that size deal as you are in a larger deal, right? There's obviously more risk associated with higher money, and you're spending a little bit more time, maybe allocating more resources, but certainly, and it also depends on the seller, how organized, how much do I have to do for you, right? Am I opening up a data drive and everything that I asked for is there and I only have to do some follow-up? Or does my team have to go to your location, load it in, I'm not joking, at our hourly rates?
I'm not joking.
Organizing it, yeah, it's going to be expensive, right? So I don't know if anybody wants to comment on that. You're avoiding that question.
I think you introed it right. We all have our own kind of structures. I think the way investment banks and Paramax included work, the way we operate, we try to align ourselves with the interests of our client, right? So as long as there's a successful transaction, we have a success fee that's based on that. Market rate, again, similar to you, we have billables along the way. There's a lot of discussions that happen around that in the engagement letter stage that, a lot of detail I won't go into, but we're always aligned with the client's interests, right? The better you do, usually the better we do to a smaller degree. So we're always aligned in the same direction.
From the accounting side, same thing as Christian, depends on how prepared the seller is, the complexity of the transaction. But usually through tax planning and things like that, we can provide an extreme amount of value. So I think that helps. Ron, did you have a question? So for the audience at home, the question was, what are common deal breakers or a big deal breaker, either for the buyer or the seller, that will kill a deal relatively easy?
So you're number one, right? So biggest deal breaker is Bill.
Right. Me. No. Honestly, so many times transactions fail that I see because the seller hasn't told key members of his team, and they make the due diligence process virtually impossible. And if you have a sophisticated buyer, they're just going to say, fine, we'll move on to the next company, right? If you won't give me the information that I need to verify what type of business I'm ultimately buying and going to be running, then I'm just not going to do it. And that is I see that more often than not, that, I haven't told these people you can't interview them, or, I'm the owner and I'm going to upload all the stuff that you need, but I don't know how to do it. So you get partial information, and you have a good company or like a good buyer. They're gonna be like, nope, I'm out. That I see a lot.
Yeah, I mean, it's one specific thing, but certainly value, right? You sign an LOI, you think you got the right price. I joke, but the buyer comes and actually analyzes the QOE and says, wait, you know what? That's not it. So it says, well, that's my price, take it or leave it. And the buyer can jump. And we usually have, I don't know, guys, 15-ish LOIs active in our group at one time. And, we have to staff them when they do go. Optimistically, a third go. So that just tells you that 2/3 are dying at LOI stage through diligence, which is QOE, figuring out the purchase price and what are the hidden liabilities, right? And to your point, oftentimes sellers are like, why do I have to do this diligence thing? Why do I have to give them this? Why do I have to do that? And many times they don't have competent counsel, or it's their counsel that they've had, he's 75 and he's not moving. So a buyer will get impatient and move on, or just leverage harder on the purchase agreement. So
I'll keep it brief. I think you touched on a lot, and I think there's even a lot more here to unpack, right? We see various things happen all the time. Some of them in a client or a buyer's control. Sometimes it's economic or, other reasons. But the one thing, and I want to tie back to, Christian, what you were saying in terms of be honest and upfront with your advisors, with yourself. The more you disclose upfront, the more your team can protect you. And you talked about the likelihood of a deal succeeding. You can significantly increase the odds and the chances that a deal will happen for you if you're upfront and you plan accordingly. So I think really that's the key takeaway. I think some things you can't protect somebody against, but there are a lot of things that you can if you're prepared and you're aware.
So we did have a question come in from cyberspace, and that was, if I'm not sure if I want to use a broker, where can I find a buyer, or if I have a smaller business that might not be the right size for a broker, are there any options to find a buyer? Billy said, talk to professionals. Yeah.
You don't want to talk to a broker.
Yeah. Right. Yeah. But talk to your accountant, talk to your attorney.
So those that come in, because we don't have those, I value the business $1 million. It's a nice little business. Maybe it could be a strategic. The easiest one is who are your competitors who are out there that somebody can go out masked. We're selling a business that you do, had those succeed. There are consulting groups that do outside insight consulting, things like that you can talk to those folks and say, anybody looking for deals, and certainly professionals. So many times I'm not an investment banker, neither is Corey, but we know enough people where somebody comes in and says, I want to sell. Do you know of anybody that might want to buy? And, with permission, I can send that out to those that I think might be interested. I'm not getting a fee for it, but if there's a transaction, then that benefits.
Yeah, you
benefits
helped me with a
everyone.
little one time. But then,
Yeah. So, advisors going to competition is a little dicey, but I've seen it work.
But Adam
But-
is good at his job.
Yeah, but to Adam's point, because I know you're gonna say it,
Yeah.
you're not getting the right value. Right? Go ahead.
Right. Finding the perfect buyer at the perfect time is ultimately what's going to maximize the value for you. Christian, everyone on this panel has a ton of relationships, whether they're private equity groups, whether they're strategic groups that have been clients in the past, right? We are constantly looking at the market. We are constantly talking to people every day. We know who's interested in what. But it's a very good question in terms of you can't always afford to hire every single advisor that you want to hire. So my advice in that situation is really picking back off what you said, Christian. Look at confidentiality, be careful, because if you just unsolicited, in an unsolicited way, reach out to all your competitors, well, all of a sudden there's blood in the water, right? So at the very least, talk to people to figure out how you can protect yourself and have the conversations in the right way. Because the last thing you want to do is say a deal doesn't work out, or you decide not to sell. You've damaged the potential success of that business in the future just by approaching people the wrong way. So confidentiality, we didn't specifically address it today. It is one of the most important items in a process. So always be worried about that. Business owners, everyone knows how important that is. So it is very important. All right. Sure.
Last chance questions. Cyberspace says nobody. All right. Thank you, everyone. Hope you enjoyed it. Cocktails are over there. Hopefully you'll stick around. What's that?
Valuations.
I guess there's
Yep.
emails.
So hi, everyone. As soon as you log off, you'll get an evaluation on Zoom. And for everyone here, there's an evaluation at your seat. If you could just take a couple seconds, a couple minutes and fill it out, we'd appreciate it. And sorry for the inconvenience, and thanks everyone for staying with us.
Thanks, everyone. And remember, I solved the problem.
Log in as an attendee.
I don't know. No, it was